start the recording. So I'd like to welcome everybody to Transformational Tuesday. Sounds like I've got to do a little better explanation of Transformational Tuesday, other than it was the best suggestion when we were trying to rename this webinar. So I appreciate everybody showing up. These are always recorded if you show up late or you can't stay for the whole thing or you're going to miss a Tuesday. I have put my contact info in the chat. I'm always interested in connecting with people, helping people learn more. So we really appreciate everybody showing up. I am going to start sharing my screen. I actually have a lot of slides tonight. Normally, I don't have this many slides, so we'll see if I get everything all done or not. But today is Tuesday, July the 22nd, and we're going to talk about unlocking the blueprint to sponsoring profitable real estate deals. So again, this is an educational series. I am not your lawyer, financial planner, real estate advisor, maybe a little bit real estate advisor, but I am not a professional. And what we're doing here is we're presenting what we believe to be true. And you should always do your own due diligence when you are looking to do any investments. So again, a little bit more about myself. I started out in 2018. I started as a passive investor. Since then, I've invested in 20 syndications. Anybody who showed up last week, I got one more sponsorship side on under my belt here. It's a 506B, so I can't talk about it here, but 34 total syndications. A little bit about Massive Capital. We're a vertically integrated real estate company. We're a developer of Class A retail and town centers, and we're an owner operator of value add multifamily. We're very Texas based, but we do have assets in Denver, Colorado, North Carolina, and Atlanta, Georgia. We do partner with a company called Realty One, Houston based company, and they do retails and town centers. They have about 300 million in assets under management. And then Massive Capital itself has 210 million assets, $210 assets under management. We do LP equity, retail, and family office. We do triple net leasing brokerage. We do land development, steel frame construction, and then we have our mastermind with Massive Masters. So we do land development, building, and building operations. So a little bit about tonight, we're going to talk about how to make money as a syndicator. What is a syndicator, GP and LP? Going to talk a little bit about GP fees, GP profits distributions, GP promote fee, raising capital. I'm not going to go deep into raising capital because that's a whole topic unto itself, and a lot of legal things. And then we'll have open discussions and Q&A. So again, a real estate syndication is a group of investors who pool or buy developed real estate. Syndications are a way for investors to invest in larger properties that they couldn't afford on their own. Syndications are totally passive. How it works is sponsors, general partners, GPs, and that's what we're going to talk a little bit more about today, is the GP roles and how they put their deals together. And they're experienced real estate professionals who organize the syndication, secure the funding, and implement the business plan. Limited partners are those who invest into the property, they fund the project, and they actually own a portion of the asset. So again, many of our deals come with what is called a 70-30 split. Talk a little bit about that a bit later. What that means is our limited partners own 70% of the asset, and then us as sponsors own 30% of the asset, and then our ownership is based on our contribution. As a limited partner, you have limited liability, so your personal assets are protected. The only thing is at risk is your investment. It also allows you to focus on specific projects and be able to invest in different asset classes. So as I mentioned before, I'm invested a lot in multifamily, everything from value add to brand new build, storage, land development, retail development, and medical center. I'm going to start getting into RV parks, storage as a GP, and we have a part of folks in our group are doing some assisted living. Pretty excited about that. So there are two types of investments that you can invest in, or rules for syndications. So we are selling a security, and when an opportunity is a 506B, we must have a pre-existing relationship and you must be considered a sophisticated investor. Part of the reasons for showing up to these webinars is hopefully we'll help you with being able to become a sophisticated investor. There are only 35 spots that are allocated for non-accredited investors, and our massive capital always allows our community to get first access to those, but I cannot generally solicit them. I cannot talk about them. So for example, I mentioned earlier, I'm raising for a 506B right now, but I'm not allowed to talk about the opportunity or anything here, only if we have a previous existing relationship. You can't advertise it anyway, then anywhere. Then deals go to a 506C. Some deals just start as a 506C. And for a long time, this was what was only available until they did a bunch of changes to the rules. And it's only for accredited investor. Accredited investor means you have $1 million in assets excluding your home. You have an income of over 200,000 single or 300,000 as married. And for me, as someone promoting it, there are no restrictions on soliciting. So it's the biggest opportunity to market to everybody. So again, when I have a deal that's a 506B, I can't talk about it in a public forum like this webinar. I can't talk about it on my social media. I can only talk to people that I have a pre-existing relationship with. One thing to note, there's no difference between the 506B and the 506C, only who can invest and do you have an existing relationship. So again, if you're interested to hear about my 506B, all we need to do is set up a call, make sure we have a relationship, have some sort of documentation, and then I'll mark that you're waiting for the next 506C. That way you even get better than first. You'll get a personalized invite telling you what's coming and what's happening. So we're going to talk a little bit about how do syndicators make money for their active duties as a GP or a sponsor. And I want to make sure this is not a complete and overall guide. It is a very complex business arrangement. There are a lot of nuances to the deals. There are a lot of rules and regulations, especially around capital raising, which is why we're not going to do it. But again, what I want to talk about most of the times I'm talking about here are passive investing. That's where your money goes to work for you. So again, our goal is to roughly double your money in 5 years. And so that's how your money goes to work for you. Me as a sponsor, I find deals, I put deals together, I collect deals, I raise capital for deals. I do lots of things, and that gives me a percentage of the GP sponsor bucket. So again, on the 70-30, as a general partner, if you remember before, I mentioned 20 is a limited partner. I'm just purely a passive investor there. 14 deals as a general sponsor. I'm a GP there, and I have duties, roles, and responsibilities. I'm doing this on a full-time basis, and that's how I get some of my money. That's how I earn money. So while my investing is passive, my real estate activities are actually very active. I'm doing these webinars on a regular basis. I'm a coach on a real estate group where I do coaching calls and have a lot of people. I do a lot of engagements. I do a lot of things. And how I get compensated for those is to be able to own a portion of a deal. So again, syndications make money for the GP and their active duties as a sponsor. So real estate syndicator or real estate syndications, also known as sponsors or general partners, earn income through a combination of fees charged for their service and their share of the profits generated by the real estate investment. So again, 70-30 split. As a GP, I'm making a percentage of the 30%. Again, mine is different on every deal, depends where I am on the deal bucket. So again, how do I make this money? It comes in the form of fees. And again, when you attend a webinar, we will always disclose what the fees are. So the one fee that happens a lot is an acquisition fee. That is an acquisition fee for purchasing the asset. And again, sometimes not everybody in the GP pool gets a portion of the acquisition fee. Sometimes they do, sometimes they don't, but it is a way for you to make money. So again, this fee can be anywhere from 1 to 3%. There are groups that charge more than 3%. I've never participated in a deal where it's been a larger than 3% because I want them to make the majority of their profits at the end of the deal. So again, if an opportunity is a $10 million property, we charge a 2% acquisition fee. So that $200,000 will get split up to us as general partners. Then there's an asset management fee. So as a syndicator, we collect a fee for operating the syndication. So again, it's for the ongoing syndications, general oversight and management of the investment property or portfolio. This is typically calculated as a percentage of gross revenue or the total capital raised, and it's often between 2 and 4%. Again, it can vary. Ours are normally 2%. And so if a property earns $100,000 in a month, we collect a 2% fee. And again, I don't get very much. In fact, I get almost nothing on asset management fees because it's not my role. I'm not necessarily the active asset manager. It normally goes in at massive capital. It feeds us to have all of our back end. So we have a full-time financial analysis on board. We have a person who does a lot of our underwriting on board. So we have a lot of paid positions. So this is how we make money to be able to make the company function. Sometimes there are construction and development fees. In the case of involving renovations, new construction, syndicator may charge a fee for overseeing these efforts, and it's usually a percentage of the capital expenditure. It can be anywhere from 5 to 10%. So again, what will happen is, let's say we're spending $1 million fixing up a property. On top of the asset management fee, we may charge what's considered a management fee for managing the construction operation. It doesn't always happen, but it can happen. On some larger deals where there's a lot of development work and a lot of things that are happening, you can get these fees up as high as 10%. Now, again, these fees are normally tied to what is spent. So again, you buy a $10 million apartment complex, you're going to get your acquisition fee, and then you have $1 million worth of renovations to do, you may get 5% of the $1 million to be able to manage the project efficiently. It's basically how you get paid for your time. There's also fees for a refinance fee. This can also be called a disposition fee at sometimes, and it's a fee that's paid to the syndicator for refinancing a property. And actually, the disposition is at the end of a deal. So refinancing again, if we've said, hey, we got this loan and in this much time, we're going to go get another loan. And that happens a lot. So you may buy a property that's unstabilized, you need bridge debt, and it's a lot of work to go get a new loan on a property. So again, on massive capital, whenever we do a fee for that, ours is 1%. So again, it's 1% of whatever the loan amount is. So on a $10 million property, it may be a $7 million loan, and we would charge a fee for the work to be able to arrange that. Ooh, stuck here. Disposition fee. So this was the one I was mixing the two together. This is charged upon the sale of the property. Again, when we sell a property, it's a lot of work. There's a lot of things that can happen. There's a lot of moving parts. So another way for us to get compensated for our time is a disposition fee. And it helps for everything that we need. And again, at Massive Capital, we charge a 1%. I have seen them as high as 3% on other more complicated deals. So again, on Massive Capital, we do a 2% acquisition fee, 2% asset management fee, 1% refinance fee, which we haven't refinanced the deal currently. We're working on one now. We're actually not going to charge for it. And then a 1% disposition fee. All of these fees should be disclosed when you're shown an offering. And also, they all included in your estimations. So it's not like we tell you, hey, you're going to double your money minus our fees. No, it's normally the fees are included in that, and they're included in all of our expenses. They would be included in any property performance and anything that happens to be able to do it. So again, this is just disclosing how we make money. Oh, boy, my slide's spinning. Uh-oh. Then there's the profit distribution. So again, if you remember before, I said there's a split, right? A 70-30 split. So they get the profit distribution. So sometimes there's a preferred return. Normally the preferred return is for the LP partners. but sometimes there is some sort of preferred return on the general partnership team. We do not do one. So we do a 70-30 split, and we do a 7% preferred return. So what happens is until our investors make 7%, and you have to accumulate that, we don't make any of the splits. So it's the preferred and then the split. But sometimes syndicators do have a preferred split where they're collecting some money during the things. This is very common here, which is called the profit split or the promote. It's the investors receive their preferred return. So again, until you make 7% of your money, and then there's a predetermined ratio, often raising 70-30, even 50-50. It's always in favor of the investors. So the higher number is normally always the investors. And then it's potentially shifting in the syndicators fought on a higher level. So let me give you an idea what that means. So again, most of our deals are 70-30, but some of our deals have what's called a waterfall. So if we achieve a greater result, the split may go to 50-50. We do this on a lot of our development deals because there's a lot of work and we don't take any of the management fees. So what we'll say is, hey, you put your money into the deal, you're going to get a 7% preferred return. If we don't exceed a 17% return, a IRR return, it's going to be 70-30. If we achieve greater than that, the split will be 50-50. So again, investors get paid first. They get paid more if we don't do as good as we promised, and we get paid more if we do as good as we promised. But remember, all along, the investors will always get paid more. So again, most of our deals, we talk about a 20 to 21% IRR. If we achieve that, that is calculated at the 50-50 split. And this is what's called the promote. So this is again how somebody makes the money. Okay, important notice that fees and profit sharing arrangements can vary significantly depending on the nature of the deal, syndicators' experience, track record. It's all negotiated between parties involved. Investors should carefully review the private placement memorandum, PPM, or other offering documents to understand the terms before investing. So I'm going to say one other thing here. So again, ours are normally 70-30 splits. There are some deals I've invested in that are 80-20 split. I'm invested in one deal that's a 90-10 split. And you may think, well, Trevor, why don't you invest all the time in a 90-10 split? And I'm going to tell you why. Normally a 90-10 split means it's a really skinny deal. And to make the investor returns look better, more enticing to get investors, the general partnership team will take a little bit less. I do not like to live in a world where it's imbalanced. I like to create a win-win scenario. So we find an asset, we collect our fees up for doing the different things. It's a 70-30 split because we want to be fairly compensated. You don't want to reach a period where I'm in theory kind of working for nothing. The deal was really tight. I just made it better terms for you to attract you to invest, and then I lose interest in it. I never want to be in a situation like that. Now, the deals that I'm in, the one that's 85-15, they are still very interested in the project. Everything is going okay. I just want to make sure that you understand all of the differences. So again, real estate syndications profit splits are defined how the earnings from the properties are divided to general partners and investors. Here's a closer look at how some of these work. So there's a straight split model, right? So it's just a 70-30. So again, LPs will get 70, GPs will get 30. So this is just a straight split with no waterfall. It could be an 80-20, it could be a 50-50. Could be lots of different things. While it's easy to understand, it doesn't always prioritize the investor returns before the sponsors. So again, on the one that has the pref, you're going to get paid first. So if we don't do real well, you're going to get paid first before I get paid. So I'm going to work extra harder to get paid. Doesn't mean this is a bad way to structure it. You just need to understand the differences between the two. So then there's the waterfall structure that I mentioned before. It's complicated, preferred method, especially for projects with multiple phases or performance thresholds are key. So again, the waterfall structure uses a series of tiers or hurdles to determine the distribution order and percentages. So again, on our development deals, there's still a 7% pref. We like that because we think it's an investor first approach. If we don't achieve greater than 17 IRR, which is the internal rate of return, it's a 70-30 split. And if we achieve 20% or greater, and this again, this 20% is calculated with the split in mind, it goes to a 50-50. So again, you want to make sure that when you're dealing with it, that sponsors getting paid more are based on performance thresholds. So we did better, we worked harder, we got the deal done better. Done better, is that good English? And we were able to do it. So there's some common tiers, right? So there's the return of capital. So again, you need to understand there's a great book by a gentleman called James Kamasami, and it's called The Passive Investor. And they talk a lot about the difference between return of capital and return on capital. So you really need to understand the difference. Return on capital means that you put $100,000 in the deal, and I actually gave you $50,000 back because we did a refi, but you're also diluted because now your ownership, it goes down in half because I've given you half of your ownership capital back. That can happen on some deals. So again, you need to really understand, is it return on capital or of capital? And actually, that's a good idea. I was thinking of what I could do for my next webinar, and I'll maybe do that. And then there's the preferred return. Now, again, preferred returns can be, I got here between 6 and 10%. There's some deals out there that have 12, 15% preferred returns. And again, you would think, oh, well, Trevor, why don't you invest in those? You have to remember that passive investing, you want to create a win-win scenario. So if I've offered too high of a preferred return and I have no hope of making any money, while I'm morally obligated to keep working on the project, I'm just not near as motivated because I want to have my profits aligned with my successes. So again, you just want to make sure that you understand how things get paid out. And sometimes there is a preferred return. This is a little bit complicated. There's a little bit more on the sponsor. So the bank gets paid first. Sometimes there's a whole group of investors that are just a preferred return. And then there's the limited partners that get a preferred return. And then the general partners would be fourth in line. You just want to make sure you're aligning and you understand the capital stack. You never want to have a capital stack where the general partners are getting paid before and above you. You never want to get into that situation. You always want to be sure that payments are aligned and go back and forth between. So again, you always want to make sure it's a passive investor focused opportunity where you get paid something, you get the bigger part of the split. And then us as general partners, we are performance driven. So we have to do a good job, do a good deal for us to get paid. Sometimes there's called the GP catch up. Okay, so what will happen is we didn't get the 7% paid for a while, but then we did get paid the 7% for a while. So now we've caught up and you've accrued your 7%. We need a catch up. We need to be sure that now we're getting our portion of the profits. So it may seem a little bit strange. Okay, first of all the money goes here. And then once you've caught up, you're kind of stopped and I'm getting paid. So again, you need to make sure that you understand, how is this structured? What happens? All of these things would be disclosed in the PPM and the operating agreements. And again, there's the promote, the split. And we talk, I think this slide is a little bit redundant here. But again, you want to make sure that we're doing these things. I also forgot to disclose, often as a general partner, I may still be an LP. So when I invest in my own deal, my cash investment is treated the same as the other limited partners. So again, if I'm raising $5 million for a deal and my sponsorship team puts in $500,000, my $500,000 is the same as the limited partner investment. So again, you want to make sure, because that's my cash working for me, and my promote or my GP portion is my running the deal, working for the deal that I get paid on. So again, you need to make sure that you understand that. There's a lot of factors that can influence the split, right? So the deal structure, the specific terms and syndication agreement are detailed in the private placement memorandum, and it will govern the split and the waterfall. There's property type and market. So different types of properties, different markets may warrant variations in the split structure. Again, a lot of these things are here. Things that you want to look for is experience and expertise track record. Experienced syndicators may command a higher profit share. It's interesting. So they don't often, but there's some real famous syndicators that make a lot of money. So there's a very famous couple of syndicators out there. I don't want to mention their names. You can ask me privately if you're interested. They actually charge a 4 to 6% acquisition fee. So these guys, they're buying 50, $60 million properties. They're making $3 million the day the deal closes. They're making a lot of money because their name and their brand, and they have been successful. So again, as long as they disclose it, it's not dishonest, but you just want to make sure. Risk profiles of the investments. So again, some deals that are higher risk may be structured with more investors friendly splits. So again, this deal is a little bit risky. We want to make sure, so they do different things. And there's also some other things. The risk also can be on the general partner side. So on our multifamily deals, we're getting those are all non-recourse debt. So if the whole thing blows up, and as long as we haven't done anything dishonest, they're not coming after us. On our development deals and on our land purchases and our other things, those are all full recourse loans. So again, that's why we tend to go for a larger percentage of the split. If we do well, we want to cover our risk because we've had to personally guarantee the loan. We've had to pledge some real property. And again, when you're taking on a loan, you're doing a lot of complicated things, right? So you're signing on the loan, you need to have the net worth of the loan. You need to have 10% liquidity of the loan. So you're getting a $10 million loan. You have to be worth $10 million. You have to have $1 million liquid. So there's a lot of things that go into it that you have to do to be able to be a syndicator. So in summary, understanding the profit split structure is crucial for investors to invest in real estate syndication. Waterfall structures with their tiered approach to distributions are designed to align the interests of both the investors and the syndicator while also incentivizing strong property performance. Always carefully review the offering documents to ensure the profit distribution model aligns with your investment goals, risk, and tolerance. So for example, there's several investments I have completely just passed on, even though they looked like killer deals, because I didn't think the splits were aligned. There was one particular property, and I just did not believe that the splits were fairly aligned. There was a way too much of a big win on this particular opportunity. If they were successful, they were basically, it was going to be a 60-40 split in their favor. And while the deal was amazing and they were going to triple my money supposedly in a couple of years, I just didn't like it. It just didn't sit well with me because again, I want our interests aligned. So let's assume after covering all of the expenses generates 150. So again, LPs will receive $900,000 for capital. LPs will receive 72,000. That's their 8%. The GP receives their profit to catch up to the agreed 80-20 split, and the remaining profits are 80% to LPs, 20 to GP. So again, it follows this whole structure of a breakdown, different things that it can do. Simplified example, waterfall structures can involve more tiers, complex calculations, especially when using metrics like internal rate of return to determine breaking points for profit distributions. We use IRR quite often on our returns to calculate our waterfalls. So again, it can make for very complicated distributions. So again, I have a project right now. Unfortunately, we're about a year behind. And remember, IRR measures the time use of money. We're going to be challenged to hit our goal on an IRR, even though we think we're going to hit the multiple equity. Because again, IRR measures the time use of your money. So if I take your money and hold it for a little bit longer, even though let's say at 1.6, your money still, but it took me 4 years instead of 3 years to do it. I had to tie up your money for another year to make your money. So again, it's critical for investors to carefully review the specific terms in the outline, the private placement memorandum, other offering documents of a real estate to understand how the waterfall and distributions will impact their returns.
And now, here's someone you want to hear from, our sponsor.
For over 15 years, Skyline Title has been a trusted name in Texas real estate. From first-time homebuyers to seasoned investors, our team ensures a smooth, reliable closing experience every time. Backed by a decade of partnerships and proven success, we take pride in protecting your biggest investment, your home. Visit SkylineHTX.com to learn more.
Raising capital. Okay, so I am not going to get a lot into the legality of raising capital, but when you are looking at the structure of who gets what in a deal, there are things like finding the deal. There are things like signing on the loan, being the key principal. There are things like having the net worth. There are things like operating, so you're the asset manager, and then there's raising capital. So there's a series of buckets, and depending on how many buckets you have a role. So for me, most of my role is in the bucket of raising capital. I get a little bit overall of the general just through massive capital, but it is really tied. So again, I want to make sure I'm super careful. I've got a QR code you can scan. There's this guy, Marcel Ruel, who's a syndication lawyer. You want to make sure that you're raising capital legally. So simplified, oh, sorry, that one's the same. So for raising capital, what is the most important thing that you need to do to raise capital for a syndication? You need to build trust and credibility. I do these Tuesday webinars to gain trust and credibility. My goal is to educate you. My goal is to provide. I call it an earn and learn. I want you to come here. I want you to learn. I want you to understand different things about it. So I'm trying to build my trust and credibility. So transparency and education. Sponsors should be transparent about their investment, their risk, and potential returns. They should show their knowledge in the market, specific market, and in the syndication process. Could you imagine if I was raising capital for a deal and you kept asking me all kinds of questions and I didn't know the answer? Now, I'm going to be honest, I don't know all the answers. Never say I would, but I can always find them out, right? We have a whole team. We have a team that understands the underwriting better than me. We have a team that understands the financing better than me. We have a team that understands the asset management better than me. We have a team that does all the different things, and we all have roles where my role is investor engagement, connecting with people, helping people learn. We all have different roles. So again, you want to showcase your knowledge into specific properties and syndications, and you want to leverage existing relationships, right? So again, I spend so much time connecting with people who introduced me to people, who introduced me to people. We do these webinars so that we hope we get some new folks in. So again, for raising capital, I want to build my network. That's why I'm always putting my contact info. I want you to connect with me on LinkedIn. I want you to join our Facebook groups, do different things. You're going to be able to do marketing. So you're going to create valuable content, blogs, posts, videos, etc., to establish yourself as an authority in real estate syndications. This really does work. Now you have to be super careful. Again, I mentioned before, if I have a 506B opportunity, I can't do any marketing about that opportunity. I can't talk about that opportunity. I have to be very careful not to be seen as priming the market. So again, very important that we do these things, but we try to create a lot of valuable content. Again, if you click on my link tree, you'll see I have a YouTube channel, provide lots of things, different things. Partner with experienced sponsors. Part of the reason I joined Massive Capital is I wanted to be part of a bigger team that had more experience and had more track record, had different things. They'd all been in the real estate. My actual very first passive investment was with one of the partners of Massive Capital 6.5 years ago. He was one of my original mentors. So again, you want to be sure that you partner with experienced people. When I first started doing this, the number of people that asked me to join their deals was staggering. I'm like, I don't know you, you don't know me. This is a recipe to put investors' money at risk. I don't know that market. Do you live in that market? Oh, no, I don't live there. I've been doing research and I decided I'm going to buy in this market. Well, no, you want to make sure. And the reason we buy a lot in Texas is we're all based here. We understand the Texas market. Why do we have assets in Denver? We have a partner there. Why do we have assets in North Carolina? We have a partner there. Why do we have assets in Georgia? We have a partner there. We have people that are experienced in the marketplace. You don't want to be building your experience on your investor's nickel. So raising capital, so you're going to want to target investors, right? So again, you focus on accredited investors who meet the certain financial qualifications. I spend a lot of my energy looking for sophisticated investors that aren't accredited. I would say 60% of the people that have invested with me are not accredited because I spend so much time analyzing it. I spend a lot of time pitching deals. I calculated it once. I think I pitched over 200 deals in all the period of time that I've been doing this. And you need to make sure that you do the deal presentation well. You want to make sure that people feel comfortable, feel safe giving you their hard-earned money. You want to be sure you address investors' concern. You need to be prepared with answers to questions about the property, about the investment structure, and the potential risks. And again, when somebody asks a question, if you don't have the answer, you need to make sure you get the answer and you get it to them quickly from somebody who does. And then obviously I secure commitments. So normally what will happen, I'll have a meeting with somebody, they'll make what's called a soft commit. Yeah, I like your deal, Trevor. You can put me down for 50,000. I send you the link, you get on the portal. So that's called a soft commit. Then you'll basically create a profile and you'll start filling out your paperwork. We call that a cash flow portal just for our thing. So you've committed there. Then we'll countersign the agreement. And again, not until your money hits the bank do you own a portion of that syndication. So we secure all the equipment and we go through everything. If it's a 506C deal, we got to make sure they get all their accreditation letters uploaded up to our portal. We make sure we do everything through our portal. All communications go through there. All of your K1s get uploaded in there. All the different things that happen in that area. So there are some legal ways to raise capital. I'm not going to spend a lot of energy on this. I'm going to give you a good link to it. So again, you could become a broker dealer. This is not an easy way to raise capital. It's super complicated. You can become a registered representative, relying on exemptions to be a broker dealer. And then there's the co-GP model. That's what I'm in. I'm in the co-GP model. I cannot take any transaction-based compensation. So I can't say, I'm going to raise this much money and you're going to pay me this much money for raising that much money. And again, it sounds a little bit complicated. It is certainly complicated. They want to make sure, because you have to remember, we are selling securities. So we have to be sure that we're very careful on selling securities. You need to be doing substantial duties. You cannot just raise capital. Going to be honest, there are a lot of people that are. And again, it goes all great until it doesn't go all great. Okay. And I don't look good in orange, so I don't want to be there with the SEC federal investigation. I've unfortunately got a few friends I got one, he's under indictment. And I think he's going to be wearing orange. It breaks my heart. He just started doing crazy things and, he violated securities laws. They take it very seriously, right? They've given us these legal structures that we have to follow. And there is another one that I'm starting to spend a lot of energy on called the fund to fund model. So what happens is I form a fund and then you give me money to my fund. So I get 10 people with $100,000 and I have $1 million in my fund. And then we invest that $1 million into somebody else's deal. We are all limited partners. I would not be a GP in that case. I would be a fund manager. And so we pool our money. And what happens there is you can sometimes get a slightly better split. So for example, ours splits are 70-30. we might give somebody who brought $1 million from a fund in an 80-20 split, and then the fund manager decides what is he going to do with the spread. Is he going to keep the spread? Is he going to share part of it? I've seen folks, what they do is they'll say, you're going to make a little bit more money if you invest with me, because we're going to give you, instead of 70-30, we're going to do a 75-25. But really, they're getting an 80% split, so they're getting the ones to do it. But this is a very, very becoming a very popular way to raise capital. Now, if you want to scan that, I meant to have the link and then I forgot to save it, but this is a great video. And if you're interested in learning about raising capital legally, I'll try to find anybody can't scan that, just reach out to me and I can give you his link. Is a lot of great information about legally raising capital. For those of you that are living under a rock and don't know, we have a ladies group that meets on the opposite Tuesdays. Now, next week, there's actually no meeting because we meet the first, they meet the first and the third, and then I meet the second and the fourth, and next week is the fifth Tuesday. Sort of dawned on me, so I didn't have anything planned for next week, but it happens again in September. I'm going to have something happen there and I'm going to try to do something, have a special day for that. And again, my goal is to help 100,000 people reach financial independence through real estate investing. My goal is to connect with people, help people to be able to learn. I put these webinars on to help you understand. So I focus on actively passive, which means we're going to educate you to understand your deals, know what you're doing, make sure that you can invest. If you are interested in being actively active, so if you were interested in being on the sponsorship side, we do a Centurion Expo. It's here in the Texas market. But what we basically do is we do 3 days where you can go through some training. We do have a mastermind that has a membership for it. But if you wanted to switch and become an active sponsor and have Massive Capital as a partner on your deals, you can go ahead and get some information from me. Or if you're interested, it's 7:15 after this webinar tonight. This is my original mentor, Phil. He's the one who moved my goal from 10,000 to 100,000. These are the Massive Capital, and this is Shanoa Grove and Olivia. They're part of my original real estate group that I joined, and they're also a part of Massive Masters group. So again, massive dreams need massive action. You've got to be taking massive action. You've got to be doing things. You are one decision away from a new life. So again, passive investing, active investing, whichever choice you decide you'd like to do, you are one decision away from being able to do that. So I am gonna stop sharing. I didn't see any questions pop up, so either you've all fallen asleep or I did such a great job that you don't have any questions. We've got a bit of time for questions.
So Trevor, I've got a question with regard to, can you explain the philosophy as far as concentration versus diversification with regard to, let's say, $500,000, just from a general standpoint, is it, when you're just starting out, is it better to consider 5 investments of 100,000 with that 500, or let's say something closer to 500,000 single investment?
Yes. So
that's my philosophy.
My personal advice is that you're going to want to spread it out. Okay. Unless for some reason, so for example, I was telling you, I can't talk about the actual deal, but it's the first deal for a group of folks in our mastermind. And they put, they're raising $2 million and they're putting 700,000 into their own deal. Okay. So again, they kind of put their money where their mouth is. But if you're a passive investor, so I was talking to a guy today and he was looking to invest in that, and he had over $100,000, and he said, should I put it all in one deal or spread it in 2? And I said, if it was me, I would spread it in 2. Now, again, you want to make sure that you have some sort of balance, risk reward balance, right? So again, you want to balance out the timelines. You want to balance out the risks. So for example, I mentioned I have a medical facility investment. It's super low risk. It's a triple net lease operation where the doctors are personally guaranteed and their practices guarantee their leases. They've got a lot of expensive equipment there. They ain't moving. Triple net means they cover all the expenses, if taxes go up, they pay it. Insurance goes up, they pay it. Super safe investment. It's actually only a 10% pref return. So there's no upside on it. There's no GP, co-GP split. But again, I wanted to have something safe. I wanted to have something that was pretty consistent. But I would always recommend that you do a couple of investments just to hedge your bets. And again, you'll have one winner and one loser, and you'll say hindsight is, right? My best deal that I ever had, they tripled my money in 20 months. That was a 56% IRR. Oh, I wish I'd have put 100,000 in, because their minimum investment was 100, and I asked them if I could only put 50 in, because that's all I had at the time. And I wish I'd have put 100 in, but I didn't. And it's just, but I would definitely. The book is Passive Investing by James Kamasami. Let me see if I can find it here. It's a great book. It's a really good book. It's and in fact, if you go onto my YouTube page, I do have it, a little snap. I've got a bunch of book recommendations there. There, I found the link on Amazon. Oh, it didn't take my. Sometimes I do copy and paste and it takes my last one. Sorry. Any other questions while I'm fixing that? That is a great question. And another thing too to consider, where whatever your sources of money are, not all investments are necessarily created equal. And when I say that, some investments have a lot of depreciation, some investments have no depreciation. So what you want to make sure you do is you balance, where am I getting that money from? So for example, if you're investing in one of my development deals, they do not have any depreciation with them. So you would want to use retirement funds for that. But if you're investing, and again, doesn't mean don't use retirement funds on a multifamily. It just means if you have multiple sources of income, you want to talk to somebody and say, okay, because I made that mistake. I had 50,000 cash and 50,000 in a retirement fund. I put my retirement fund on a multifamily, and you don't get the bonus depreciation because it's already in a tax deferred location. And I put the cash in something that had in a land development deal that had no bonus depreciation. And if I had just switched them, it would have been a substantial difference tax time. Great question, though. Oh, you can see Jess on here. He's got a picture of Phil Grove, one of my mentors. That's his screensaver there. Good to see you, sir. Glad you could make it.
Yes, sir. It's always a pleasure to be able to catch, your trainings and your videos. You're always enlightening. You're always, giving that perspective. And even after hearing it a few times, it's still like, the first time I met you, Trevor, it's almost like learning a new language. So, so even, to continue to listen to you is still learning, and it's just been impactful. So I really do appreciate.
I appreciate you joining.
Yeah, no, I appreciate the time, my friend. I appreciate you taking and making the time to put this.
And then hopefully I'll see you in Houston. I'm coming to Houston a couple of times.
Oh, really?
Yeah.
Oh, nice. No, it'll absolutely be good to see you.
Yeah. Awesome.
I guess, yeah, I've been here for a couple of months now, and this Houston's been very good to me. So
good. Awesome. All right. Any last questions? So again, remember, next Tuesday there is no meeting. And then the first Tuesday will be Jasmine. And then for those of you ladies that go to Jasmine's thing, a bit of an announcement for her this Saturday. I'm going to Houston to her wedding. So very, very excited that she invited me to come to her wedding. So she'll have a new name by next Tuesday. She's very excited. She's been trying to start get married and start a family and do things. It's all part of her life plan. So I'm super excited for her.
Hey, Trevor, I do have a question. This is
Yes.
Wanda. Okay, so you mentioned that you have a partner in Georgia. I live in
Yes, I'll
Georgia.
have to get the names,
Okay.
and I'll get them to you.
Okay, and what's the uniqueness of having state-specific partners? Because they're familiar
Boots on the
with
ground, boots on
property
the ground,
opportunities?
boots on the
Yeah,
ground.
that's what I thought. Okay.
Yeah. And if you're close to Atlanta, I got some friends that do a meetup there.
Oh, really? I'd love to have that. Yes, I'm in Metro Atlanta.
Okay.
And I've been looking
Yeah.
for a meetup group here.
Yeah, so there's will get you that information. That they've been meeting a little bit sporadically lately. They were super active.
Mhm.
But yeah, and I'll get that information to you.
Okay, thank you.
Awesome. Any other questions?
Hey,
well,
Trevor,
yep.
Trevor, do you have a minute that we can talk maybe a little bit more specific to the deal that we have?
Okay, I'll have to, can we do it after on a separate line just because this is,
Yeah, I know. That's why I was asking. Are you available?
yeah, well, I'll call you
Yeah.
right after.
Okay, thank you.
Awesome. Yeah, Tim's also part of our program.
Yeah.
Awesome. Any other questions from anybody? Well, very
Thank you.
good.
This is
So
my first meeting like this. It's kind of like drinking from the fire hose.
I know
for
it's a
me.
lot. I know. And
Yeah.
I try to not overload, but it's sometimes it's hard because there's just so much information.
Well, there's a lot to process and retain. It'll take a few meetings, I think.
It does. I'm still learning. And hopefully I never stop.
I was gonna say, we all are. Okay.
Yeah, hopefully I never stop.
Yeah.
Awesome. All right.
Thank
Well, very
you.
good. Thank you. Oh, the replays. Yeah, I'll put that in the chat. Go to our YouTube page. And the she replays are there. And we used to do it every Wednesday. So all of those replays are there. And then for those that are just can't get enough good information, this is my YouTube channel. And that book that I mentioned is there along with some other really good books. One of the good books on syndication, it's called The Best Ever Real Estate by a guy named Joe Fairless. And his products are amazing. He does a lot of education as well. His is the longest running real estate podcast in America. And he's like 40 something. And he's done all right. I think he's just surpassed $3 billion in real estate assets. And the super nicest guy you'll ever meet. He does a big event in Salt Lake City called the Best Ever Real Estate Conference. I missed last year, but I've been several years in a row. It's awesome. Very good. Well, enjoy the rest of your evening. And I'll call you, Tim.
Great, thank you.